One of the most esteemed dividend growth stocks of the last few decades would have to be 3M. Having been touted as a more recession-proof holding, ticker MMM has long been a favorite for investors for their strong track record of providing consistent dividend growth throughout the decades. But this company in recent times has been facing some pretty significant trials that's left a lot of investors wondering if their unusually high dividend is in current danger. So in today's video, we're going to take a deep look into 3M and try and figure out if that dividend yield of over 6.5% is in any kind of danger, or if buying this stock right now could be a great opportunity for dividend investors. The 3M company is an industrial conglomerate that provides diversified technology services in the US as well as internationally. The company operates through 4 different segments, which are safety and industrial, transportation and electronics, healthcare, and consumer. Each segment offers a wide range of different products, so it would honestly just take way too much time to list everything this company produces because it's a pretty extensive list. Their safety and industrial segment offers abrasives and finishing for metalwork applications, autobody repair, closure systems, and packaging material. Their transportation and electronics segment provides ceramic solutions, attachment tapes, films, sound, and temperature management for vehicles. They also provide premium graphics for advertising and electronic assembly solutions. Their healthcare segment offers healthcare coding and reimbursement software, as well as skin, wound, and infection prevention products. The segment also produces filtration and purification systems. Then finally, their consumer segment provides a long list of products including tapes, bandages, cleaning products, paint accessories, picture hanging, and air quality solutions. These are just some of the products that this company produces, but as you can see, they've got their hands in a lot of different areas. Today, they're one of the largest industrial conglomerates in the world, and they have a market cap of over $50 billion. Because they produce so many industrial goods, for over half a century, their stock has been considered one of the best consumer defensive investments out there. After all, when you make products that practically every corporation on Earth uses every day, it's pretty much guaranteed to ensure that you'll still be able to sell your products even with a hardcore recession. It's for this reason that 3M has an incredible history of consistent dividend growth to shareholders. As of 2023, the stock has grown its dividend every year for 66 years straight. This would make them not only a dividend aristocrat, but also a dividend king. These are stocks that have been able to grow their dividends every year for at least 50 years. There's currently 51 dividend kings that exist, and as you can imagine, they're pretty much all mature companies. Pepsi, Johnson & Johnson, Colgate, and Walmart are just some of the other stocks that make up this elite group of investments. In February, 3M grew their dividend to $1.50 per share per quarter, which was a 0.7% increase from their previous dividend of $1.49 per share. From my research, this appears to be the smallest increase in this company's history. With this in mind, so many people are concerned about whether 3M will be able to hold on to their 66-year streak of consistent dividend increases. Because as I'm sure many of us are aware, this company is going through some pretty significant changes and challenges right now. They're currently in the process of spinning off their healthcare segment, which was announced back in July of last year. They project the move is expected to be completed by the first half of 2024. But 3M is also dealing with a much larger issue that's been a growing concern since 2016. Right now, the company is dealing with a massive amount of lawsuits stemming from one of their subsidiaries, Aero Technologies, and their faulty earplugs that were used by members of the US military. If you're not in the loop, here's a timeline of what's been happening. The issues that 3M is going through are the result of events that started in 2003. A company owned by 3M manufactured and supplied the US military with earplugs to protect service members in training as well as in combat. These earplugs were used in both Iraq and Afghanistan and were used up until the year 2015. In 2016, a whistleblower came forward claiming that 3M knew that the earplugs that they were selling were defective and didn't meet the standards that the government required. The lawsuit further alleges that these defective earplugs caused hearing loss and tinnitus for thousands of service members. This resulted in 3M having to pay the Department of Justice $9.1 million to resolve the allegations. But this didn't end the company's troubles, as now former service members were now able to sue the company, alleging the earplugs resulted in hearing loss. In total, the number of lawsuits filed against 3M by former service members has now surpassed 300,000. In June, the US Bankruptcy Court rejected 3M's attempt to place Aero Technologies into bankruptcy. This would have significantly capped the amount that 3M could have been liable for, which would have reportedly been around $1 billion. But because the courts wouldn't allow 3M to place their subsidiary into bankruptcy, they could now be forced to pay significantly more than just $1 billion. In August, it was announced that 3M had agreed to pay more than $6 billion to settle 300,000 lawsuits, which would be paid over the course of several years. It's a pretty significant blow to the company. A $6 billion fine for a $50 billion company is a huge chunk of their value. In order to fund the settlements, 3M announced that they'll be making several changes to their business. The first is to cut costs, which 3M will do in several ways. One way they plan is to cut 10% of their workforce this year. That comes out to roughly 8,500 jobs for the company. It's also why the company is spinning off their health segment, which according to a JP Morgan analyst, they expect the transaction to bring in $7 billion to $9 billion in cash flow for 3M. But overall, since the lawsuit started, this company has been suffering significantly. A few years ago, their stock was trading for over $200 a share, whereas today 3M now trades for around $90 per share. Because their stock share price has fallen so significantly, they're now the second highest yielding dividend king stock behind Leggett & Platt, ticker LEG. But a question we need to ask is, are all these cost-cutting efforts going to be enough for the company to cover all these settlements? According to their most recent cash flow statement, last quarter it cost the company $828 million to pay their dividend. Reducing or even eliminating their stock's dividend would save 3M a significant amount of money each quarter, so this is definitely a possibility. Just looking at their most recent financial statements, we can see this company has been struggling in a lot of key areas for at least a decade. Revenue growth has almost been non-existent for this company. As you can see, it's basically gone nowhere since 2013. Cost of revenue, on the other hand, which are the expenses to produce their goods, has kept climbing for years. Fortunately for 3M, net income has kept growing over the years, but recently their free cash flow has been falling. This is where the money to pay their dividends comes out of. If this number is falling, it's a sign that a dividend could be at risk. And considering the billions this company will have to pay because of all these lawsuits, things aren't looking too good for this company from a financial perspective. On the other hand, things aren't entirely bleak for this company, as there are some good things going for 3M. They've been building up a huge cash position over on their balance sheet, which helps create a moat of safety for them. Additionally, the management team recently updated their earnings forecast and are now predicting that they'll report higher profits than they expected at the end of the year. And again, given just how many products 3M produces, it's unlikely that they'd go out of business. They've got such a strong presence in a lot of different industries that they'd be very hard to bring down. Not to mention, another really appealing thing about this stock is that their dividends are qualified, meaning that they're taxed at a much lower rate than non-qualified dividends. This can make stocks like 3M ideal for those who want to live off dividends in a non-retirement account without having to pay higher taxes. There aren't too many high-yielding dividend investments that offer qualified distribution, so stocks like 3M are a lot more appealing for that reason. But of course, that's assuming that 3M won't reduce their quarterly dividend in the first place. I checked out their latest earnings call from October, and they didn't really comment on what they were planning on doing with their dividend. In the call, they said they returned $828 million to shareholders via dividends this quarter, and that they anticipate a one-time dividend from the spinoff of their healthcare segment. Judging by the performance of 3M's stock as well as the reaction from Wall Street analysts, the market doesn't seem too optimistic about 3M's future in the short term. There's a couple things to consider regarding their dividend though. Even if the company can go without cutting it, it's still possible that they could cut it anyways if they feel like they could better use that money for internal purposes, like growing their business for example. Considering the huge pile of cash this company is sitting on and the fact that they'll pay this settlement over a period of years, it does seem like the company can go without cutting their dividend, but again the question should be, will they cut it anyways? Considering the extra expense, saving $828 million per quarter to do things like pay down debt or invest in new ways of earning revenue might be more appealing to them. Remember, even if they don't cut it, they're still battling slow revenue growth and rising short-term debt. For anyone considering this stock, I'd honestly suggest holding off until we see if the company reduces their dividend. If that does happen, then what usually occurs afterwards is a sharp price decline for a period before it levels out, and hopefully the company will start rebuilding their dividend again. I think it's just too big of a gamble to take right now, but that is my own personal opinion. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.